Hi, and welcome to this week's special segment from Investment Masterminds on artificial intelligence and its potential role in portfolio design. My name is Jeff Thomas, and in addition to hosting this series, I'm also the regional director of Swan Global Investments, where we recently put out a piece called Correlation Conundrum, which you can access through the accompanying link. Modern portfolio theory has been under scrutiny over the last several years as correlations between investments have become closer and closer to parity. This is by no means to say that Markowitz in his 1952 MPT thesis is inherently flawed, actually quite the contrary. Diversification of investments with low correlation to each other is imperative in designing risk-managed portfolios. However, now 70 years after the introduction of MPT to the world, where can investors achieve better risk-adjusted outcomes that can add alpha, lower beta, or both? For example, at Swan, we lower correlations through the use of hedging and put options, but I'm always on the lookout for processes that give advisors the opportunity to add value to their clients. And that is what really intrigued me about StockSnips. Today, our guest speakers are Rebecca Wilde, Director of Business Development, and Ravi Koka, founder and CEO of one of the most unique systems that I've identified out there for bottom-up value in the marketplace. So, Rebecca, welcome. Thanks for coming on today.
Yeah, certainly. Thank you, Jeff. Thanks for having us.
Yeah, no problem. I wonder if you could just give us a little bit of an overview of what StockSnips is and what do you do that's so unique?
Yeah, absolutely. So ultimately, what we're doing is we're providing RIAs and investment firms with access to active AI-driven portfolio models that leverage a proprietary investor sentiment signal. And the goal is to really enable investment managers to, introduce some sort of AI adoption within their practice at a low cost that's high performing and in effect provide a competitive edge to their clients. So, we've seen a lot of these larger institutional firms adopt AI technology in some capacity. And we like to think that we can be an outsourced solution for independent firms to help bridge that gap. And, I think I'll quickly explain the why and the positioning as it relates to investor sentiment. But what we're seeing is company valuations are being increasingly driven by market emotions and what we call investor sentiment rather than strictly, fundamentals. So our models are built upon this notion, and we have actually found a way through the use of AI, natural language processing, machine learning, to derive a quantified signal that is a very robust proxy for measuring investor sentiment at the individual equity level. And this is really what's enabled us to create these AI-driven models that are actually designed, like you said, specifically to be more adaptive to the changing market conditions, and also consider this as a new alternative factor, new sentiment at the in the stock selection and portfolio rebalancing process.
I think it is absolutely fascinating, Rebecca. I'm 47 years old. I mean, I remember back in the day when I was a wholesaler, actually a financial advisor. I started as a financial advisor in 1999, and I was printing off MapQuest and trying to get to meetings. And if you missed a turn, you'd have to go back, you have to reprint it or whatever else. Now everything is internet, everything's GPS, and now we're talking about artificial intelligence. And I'm like usually a late adopter to things, and what I've learned is that these type of things can give you some efficiencies out there. So I want to kind of turn over to Ravi, and can you give us a little bit about why AI? How did you get started in this type of industry, and what led you to create StockSnips as a firm?
Thank you, Jeff, and Rebecca. Thanks for the introduction. My background, I've been around computer science, AI for more than 3 decades. I've started with mainframe, large computers, client server technology, and then PCs and internet. And then one has seen the, astronomical growth in the power of computing. Right? You can look at on a small computer chip, in a phone. You're walking around with 10 times the power of a large computer 50 years ago. So basically, every human being on Earth has now access to this massive amounts of computing power. And the second trend, which attracted me to doing what I'm doing, like I said, my background is in AI, natural language processing. So you're looking for what problems are out there that can be solved. And because of my previous company and exposure to the financial services and financial markets, one of the areas I found was that the exponential growth of information, financial information, news, especially unstructured information, not only data, not only all kinds of fundamental data, but also textual information. And this is extremely difficult for an analyst or for an advisor to sit there and sift through and find all the nuggets in that information. So that's really what got me off about 7 years ago, saying, with all this power, with all this natural language capability, can you read all these articles and figure out automatically without a human being having to read all of them? Can you identify the nuggets in these articles, and from there, can you then somehow convert that to some kind of a score, so that instead of somebody trying to do all of that manually, the machines are coming up with a thumbs up, thumbs down for each of the articles that they're reading. And then at some total of that, when you translate that to a sentiment for an individual firm, that becomes very powerful. Now, suddenly you've got a measure of investor sentiment, because the hypothesis is that people read news stories and that drives their behavior. As you know, the market, the reason modern portfolio theory doesn't work always is because the market is made up of rational and irrational investors. So the rational investors look at fundamentals, cash flows, future cash flows. The irrational, they are driven by sentiment. They feel good about something, they will act. And that's what you see in play almost every day. You've got the rational and the irrational, and that's what determines the price for any one of these equities. So long story short, the growth of computing, the growth of information, and the power of these AI tools to digest all that information in real time and to create a useful signal is what has brought us to where we are today with StockSnips.
So it's interesting. I mean, I wish I had access to this type of technology when I was in college to go through all my textbooks, because it sounds like it's a way we can kind of cheat the system a little bit by looking at this huge universe of articles and information out there that nobody could possibly take time to read through, find the pertinent information, and then translating that into an investable vehicle of some sort. So I'll kind of turn this over to Rebecca, because I'd like to get both of your kind of opinions on this. So in that process, is this something, Rebecca, do you feel that is looking at more the broader market, or is it something that's looking at like a stock by stock, sentiment on individual holdings?
Yeah, great question. And I think Ravi will definitely, expand on this. But on any given day, we're ingesting into our AI and NLP technology and algorithms, we're ingesting over 50,000 news media articles per day on a continuous real-time basis. And I think that, as Ravi said, is really one of the biggest obstacles. Even the largest firms, they have hundreds of PhD analysts who are trying to synthesize this volume of news. And to get through this, this sheer mass it's a very, very big challenge. And so that's where, like Ravi said, machines can be leveraged to, on a continuous real-time basis, extract the important pieces. And we are looking at, macro level news, but specifically, how does that affect individual equities and individual sectors? So we're able to, by being able to get that sentiment score at the individual equity level, we can kind of scale up, whether it's via sector, via market as a whole. And Ravi can, I'm sure, add to that as well.
Yeah, I think that's the unique thing. You have broad indexes like the VIX. VIX is, by the way, is a kind of a overall sentiment index. If the VIX goes up, that means the market sentiment is down. It's a fear gauge, right? It's the fear contagion among the investor community. And you saw that during COVID. The VIX hit a high of 80, the market crashed 40%, right? So, however, the VIX is not very useful to see how individual equities, there are 5,000 different equities, all of them don't behave the same way. Just because even when the VIX goes up, there are certain companies which still do better than the others. And the reason is, as you know, when there is fear, there's flight to quality, right? So for example, so when there's fear, people will say, okay, let's get out of microcaps, low liquidity equities or cyclicals and move to consumer staples, utilities, or large cap companies, because they feel more secure being in equities that are defensive in nature. So I think what's unique about us is, unlike the VIX, which is a broad index, ours is literally at the individual equity level. However, we can also derive sector sentiment and S&P 500 sentiment, or the overall market sentiment. Our market sentiment is somewhat similar to VIX, except that it's much more expressive, and we can show you through various studies that our index, our market sentiment index, reacts to even smaller events, not big black swan events like COVID, but there are so many other events, interest rate hikes and or discussions on tariffs with the Chinese. These are not necessarily as big as a worldwide lockdown because of COVID, but still that drives sentiment, and certain companies are affected more than the others. That's what we're able to figure out. We're able to use sentiment to say if interest rates goes up, which stocks are going to be less affected, and that's what the investor sentiment becomes a proxy. And we've seen that in our portfolio models, how our models have behaved, how we rotate when the regime changes from growth to value or from sector to sector. The stocks that are picked in our portfolios are different. You'll see the change and this is all happening algorithmically.
Yeah, that's an interesting point, Ravi, because when you think about a lot of people might look at AI in general and say that's too outside the box for me, looking at sentiment to try to judge where individual stocks or sectors or the overall market might be going. But I mean, you kind of put it in terms of the VIX, right? The VIX isn't risk. The VIX is the anticipation of risk. It's basically the largest options traders out there kind of thinking which way and having sentiment drive which way they think the market's going, right? So in some ways, yeah, I mean, this is kind of like another version of the VIX that's a little bit more robust because, you're talking about maybe 20 trades in the VIX or so, as opposed to, what you're doing and looking at, 50,000 articles a day. Does that analogy?
Well, yeah, think of it as VIX for the individual equity. VIX is for the entire market, and our sentiment score could be thought of as a indicative signal at each of the individual equities, which is in portfolio design. Basically, it becomes another factor. What is if you look at the factor-based investing or the modern portfolio theory, right? There are certain factors: size of the company, profitability, momentum, value, growth, right? So those are the factors. Now, what we have proven through various studies and actually through building and testing portfolios in the real market, in the live market, that investor sentiment is a valid factor in addition to the Fama French, the 5-factor model. It started out with 3 factors. Then they found that, well, these 3 factors, they explain maybe 80% of what, of market return, but they also then added momentum, they added profitability, and now there isn't any, none of the big indexes have added investor sentiment yet. But my belief is that eventually investor sentiment will also be a valid factor, which means when you're building a portfolio, like you said, a risk-adjusted portfolio, you look at investor sentiment as another trend indicator, just like price momentum, or growth. Growth earnings revision is a proxy for a growth. That's a growth factor, right? What is called business momentum or earnings revision guidance given by analysts about a particular company's growth, right? Is it going to grow 10%, 15%, 20%? So ultimately the factors, each of the factors should help explain market returns. And if it is predictive, it should give you an early signal, not after the fact.
So how does the actual process? Now, first of all, your AI machine, have you named it? Like, is like you name it like Fred or something, or Shakespeare, or you get some funny name for it, or is
no, because we use so many computers, we'll have to come up with a lot of names.
Yeah, I forget the name of the robot in Lost in Space, whatever it is. So it's interesting. So do you actually have fundamental or factor analysis as part of this process? Like, what helps you screen out just things, something off the wall that might be just coming through from a sentiment standpoint?
Absolutely. That now, once you have this signal, now you come to the next thing, which is called portfolio construction and design. That's a well understood topic, right? What factors do you choose? How do you then? There is a whole risk aspect of it. Things like volatility, Sharpe ratio, and so on. So we do look at, when we construct a portfolio, the universe that you select, you use fundamentals. For example, if you want a lower volatility, lower beta portfolio, you're going to eliminate in the universe high beta stocks, certain cyclical industries. So you whittle down, you start with 5,000 stocks, you then whittle down to maybe, then if you look at liquidity issues, you're going to eliminate the micro caps. So you'll end up with about 1,500 large, mid, small cap stocks. And within that, if you use fundamentals to screen and come up with the type of portfolio that, based on the risk appetite. So for example, we have a low beta large cap, which only picks the large cap quality stocks, not even eliminates even the high beta large cap and certain cyclical industries. So that's by design. It is for those who want low volatility, lower beta. And then we have the all cap, which does not use any of these constraints, has small, mid, and large cap. It does put a constraint on news volume because our signal quality is better when the news volume is higher. So if there is no coverage for an equity, that's not a very good signal. So we do use fundamentals, but more as a screening mechanism and as a risk management aspect of the portfolio design. But in terms of the alpha generation, that's coming from timing the buy and sell of an individual equity based on investor sentiment.
Do you have a short book? I mean, for negative sentiment?
Not for the advisors. We do have a long short design which we're taking to the market, but as you know, that's not typically an advisor will not do short selling. So that's designed for hedge funds and for boutique asset management firms.
Okay, well that's a good segue then. So who are you trying to outreach and try to talk about this process to? Really, who is it designed for in broader terms? Rebecca, why don't you take that one?
Yeah. I think we've seen a lot of adoption. It really ranges. It's more so the forward-thinking advisor, the one who knows technology is disrupting and is going to continue to disrupt, and they need some type of competitive edge to differentiate themselves, to attract new clients, to gain the audience of this younger generation of investor as well. So we're really going after independent RIAs. Ranging anywhere from 50 million AUM to 10 billion AUM right now is kind of our broad bucket. We do, like Ravi said, though, have the underlying signal, which we can also license to larger asset managers, hedge funds, for use in their own strategies. But we decided, let's give a full service solution of these pre-built models that advisors can easily embed into their current existing investment approach, and that way they have a differentiated AI-driven strategy that they can use also in their marketing efforts. So that's really, a broad range. We cater to a lot of advisors and investment professionals.
Given our size and the history of the firm, we think that the early adopters are likely to be the smaller advisory firms that are under a lot of pressure to do active management these days, competing against passive funds. It's become a big challenge. So they are looking for innovative technology solutions, and they don't have the capability. They cannot deploy all the AI tools and the technologies that we are using. So whereas the JP Morgans and the BlackRocks have large in-house teams that can potentially do what we are doing. Whether they're doing or not, I can't comment, but potentially they can because of the resources they have. But there's almost like 30,000, advisory firms that are, will not have that capability. So we think that that's from a product market fit, at least for the initial market. Now, once we are established, once we have, several, hundreds of millions of dollars assets under advisement, we do think that a large number of asset management firms will also adopt our solutions because they will not have the wherewithal to do everything that is needed. It's the investments needed are huge. So it's a multi-pronged approach, starting with the early adopters, and as this particular approach becomes more broadly accepted, I think we will go to the larger market.
All right, that's great. I have just one more question about the portfolios themselves. So, what does it look like? Are they more focused strategies when you get all the data in? Do you have a certain amount of stocks that you will allow for a portfolio design, or how does it, or is it a broader universe? Are you talking about hundreds of stocks and then you're getting some alpha through the sentiment? How does it all look when the end product is designed?
Yeah, great question, Jeff. So, we've done a ton of analysis and a lot of different strategies testing what's optimal. Is it 50 equities being held, 200? We found for the most part that 30 equities is a sweet spot. We have 5 portfolios that exist today, 3 of which hold 30 equities. One actually takes the aggregate sentiment of the spider sector ETFs. So that holds 4 spider sector ETFs. And then we also have an additional portfolio which holds 60 equities. So, they are niche, and like Ravi said, ultimately we select a universe based on the risk characteristics, and then we apply our sentiment overlay. So we're very nimble in the essence that we can create many portfolios, given this is all machine driven, based on a universe of selection. And we do that for some larger clients who have their existing universe and they want to optimize that. So we apply a sentiment overlay.
The key is that we stay fully invested in equities at all times, and we are diversified. You see, if you look at our portfolios at any time, like for example, throughout 2022, we did not move out into cash or any other bonds or any other type of asset class. We stayed within equities, but within equities, if you look at our portfolios, they're very diversified, did not have concentrated exposure to technology growth or mega cap, which is what brought the market down by almost 19%. And if you look at ARKK or innovation stocks, they were down 60% because they were very concentrated. So, and you hear this again and again after the fact. Everybody tells you, you know what, you should be balanced, you should be diversified, and our algorithms did it. Because they're not biased. They don't just go after a particular sector or particular style type of companies. So it's not, see, that's where the bias comes. If it's a human portfolio manager, he's got thematic or he's got certain biases and they're going to go after that. And that works for a while. But if the market regime changes, not able to adapt or change because you already basically put your strategy down in a particular direction, right? So whereas the algorithms, they just look at the data and behave accordingly. They don't have, they're not stuck with any particular theme. That's what we're finding with our models.
I did say the last question was the last question, but I thought I am representing the audience on this call too. So I was wondering, do you feel, and either of you or both of you can kind of give us the answer on this. Well, I guess we'll start with Rebecca. Do you feel like this is a replacement to traditional portfolio design, or more of a complement to traditional portfolios, or either?
I think that's really to be answered by the advisor who's managing the client assets, right? Depending what they're looking for, we often suggest, use or at least get comfortable with our strategies as a sleeve, as a satellite strategy. Get comfortable with performance, track it over, several months, years if necessary. But ultimately, you're lending a story of technology. You're kind of innovating your approach that you can pass on to your broader audience of clients and even in the marketing realm. So yeah, I think this is a complement, not a replacement. However, some of the strategies have, significantly outperformed a lot of the benchmarks. So that's up to the advisor to determine if that should be a replacement or not.
I agree with Rebecca. In the advisory market, this becomes another available strategy along with the other core strategies that you might have. Now, if you're a hedge fund or a boutique, then their risk-taking ability is much higher, and they might just go all out for one particular strategy because they want to maximize their return and they're willing to take the risk with it. But if you're managing clients' money, especially if these are baby boomers or retirees, you don't want to put all of your money in one single strategy. So I would definitely say this is an alpha strategy. You want to combine this with other fixed income or other core strategies that might be more long-term buy and hold type of strategies. And this is taking advantage of the trend in the marketplace. The problem with buy and hold, in the short term, when there is a trend happening, you're not leveraging that. So combining a long buy and hold, which is what one of our local RIAs has done. He's always bought and sold for 10 years, 15 years. But there are times when he's looking at the trend and he's not leveraging. His clients are saying, hey, what are you doing? What are you doing to earn your fee, right? So that's where I think, combining a trend strategy like investor sentiment with a core strategy delivers a much better outcome for the client.
Yeah, it gives them an opportunity to, or the advisor, the opportunity to potentially monetize trends that may exist within a longer term market trend. That we, sometimes these trends go on for years, but bullish or bearish. But those micro trends that may occur based on sentiment may be a good way to capitalize and monetize that process, over a short period of time. So So, well, thank you so much, Rebecca Wilde, for coming on today, and Ravi Koka. Really appreciate you telling this story because it is something very interesting. I think it's very unique, and it seems to me that it can help to really plug some of the holes that modern portfolio theory has left. Nothing to do with the theory itself, but the way that the market has evolved and correlations have become so close to one and really competitive in the marketplace as far as advisors trying to just provide alpha, where often alpha doesn't seem to exist. So this is just another tool for those advisors to be able to evaluate whether it makes sense for them. So I appreciate you coming on today and telling your story.
Thank you, Jeff. I really appreciate you giving us the opportunity to share our story.
And we'll see you next time on Investment Masterminds.